Hello. Um, Welcome to this third day of the Advanced Financial Management exam approach session to be conducted by the ACCA. Myself, Lokman Rafiq. Hello, everybody. Hope you had a good day. So basically, if I could have a quick recall of what we have done up till now over the last 2 days. So basically, we have gone through the various questions, and questions have actually focused upon. One of the questions that we initially did was focusing upon the adjusted present value technique, which is a very essential technique at the P4 level. And the second thing was we actually went through one of the questions, which was actually about the bond yield and the bond valuation. And in addition to this, in the yesterday's class, we actually went through one of the questions that was about the free cash flows to equity, also termed as the dividend capacity of the entity. Then furthermore, what we did was we went through a question which was actually about the business valuation. And then the next question that we actually attempted was some partial, and that was about the interest rate swap. So that's what we did. So that's what we have done up till now. So these are the things that we have done up till now, which is actually APV, bond yield valuation, FCFE, and furthermore, basically we have gone through this valuation and the interest rate swap. So what we are actually going to do in today's session is going to be, we are going to go through one of the exam questions pertaining to the valuation first. And once we are actually done with that question, then we would have few of the questions where we would have the foreign exchange risk and we would have an international investment appraisal. The question that we did in the yesterday's session was partially complete. It wasn't completed in full. So I would actually go through that question again also at a later stage of the today's session. So for the time being right now, what my approach is going to be, I will actually be focusing upon one of the questions because I will ultimately be moving towards the international investment appraisal scenario. So if I'm actually going to be moving towards the international investment appraisal scenario, ultimately, I would need to get through one of the questions of the investment appraisal, relatively higher level question of investment appraisal and the business valuation. So the question that I'm actually going to start off today is going to be this is okay. This is question number one of March June 2018. This is question number one of March June 2018 session. So this is what we are going to do first, and then we are going to move on to the next area. So it's March June 2018 question number one. This is what we are actually going to go about. The question, which is actually about this March June 2018, what exactly is there in the question? So if I could actually, my suggestion is going to be that whenever we actually go about discussing such sort of a question, it's always recommended that we go through the first paragraph first, and then we move on to the remaining part of the question after reading the question's requirement. So basically, it says Chicap Company is a large listed company operating in the pharmaceutical industry with a current market value of equity of 12,600. So the company has a current market value of equity of 12,600 and a debt to equity ratio of 30 is to 70. The debt to equity ratio is 30 is to 70. So debt upon equity is 30 upon 70. Now, in market value terms, now institutional investors hold most of its equity shares. Now, when you have got institutional investors, you've got a very different sort of a demand from them. The company develops and manufactures antibiotics, antiviral medicines. Both the company and its products have an established positive reputation among the medical profession, and its products are used widely. So the products are used widely. However, its rate of innovation has slowed down considerably in last few years, and it has fewer new medical products coming into the market. So there are fewer new medical drugs coming into the market. The company's rate of innovation has actually gone down. Now, what next is there? If we move a bit further, so the next situation is basically the requirement of the question is we have been asked various things, which is number one, compare and contrast the reasons for the opinions held by Director A and Director B and discuss the types of synergy benefits which may from the acquisition strategy suggested by Director B. So we are actually being told that you need to actually comment on the differences in the opinion that are held by the various the two directors, and you need to discuss that what exactly is going to be the difference in the acquisition, in the synergy benefits from the acquisition strategy discussed by Director B. The second thing is discussing how using real options methodology in conjunction with NPV could help establish a more accurate estimate of potential value of company as suggested by Director C. Now it says prepare a report for the board of directors which estimates the current value of Foshoro, estimates the equity value arising from combining Foshoro and Chicap, and evaluates whether acquisition of Foshoro would be beneficial to Chicap shareholders, and discusses the limitations of valuation methods. Then there is this part D, which we are going to discuss at a later stage. So my suggestion is going to be that you go through the question first so that we can have a quick discussion. I'll give you 5 minutes time. You can go through. Wilfred, um, Dilawar Mahmood, you need a question, so you can go and download this from the ACCA's website, and you can easily access it on the ACCA's website. Wilfred John, you have a question that is it mandatory that we write the currency at every single step of the question? So the answer is no, it is not mandatory at all. It is not mandatory at all to write that. Hmm. Okay, so I hope that you people would have gone through the question now. So let's actually discuss and let's start off. We already know that the company is actually having a current market value of equity of 12,600 million, the debt to equity ratio of 30 to 70%, and the company has a positive reputation in the market. But recently, what has happened is it has not been able to focus very well on the innovation, and the rate of innovation has been considerably slow. Now, it says at a recent meeting of the board of directors. So at a recent meeting, it was decided that the company needed to change its current strategy of growing organically to one of acquiring companies. So that's basically they don't want to actually um, grow organically, but they would rather want to grow by acquiring company in order to maintain the growth in its share price in the future. The members of the BOD had different opinions on the type of acquisition strategy to pursue. Now, Director A was of the opinion that Checkup should follow a strategy of acquiring companies in different business sectors. That means she is focusing upon the diversification. She suggested that focusing on just the pharma sector was too risky, and acquiring companies in different business sectors will reduce this risk. So what she was actually like this, that we should not focus solely on the pharmaceutical sector. Now, Director B was of the opinion that Director A's suggestion would not result in a reduction of risk for shareholders. In fact, he suggested that this would result in agency-related issues with Chicap shareholders reacting negatively, and as a result, the company's share price would fall. Instead, B suggested Chicap should focus on its current business and acquire other established pharma companies. In this way, company will gain synergy benefits and thereby increase value for its shareholders. Now, it says thirdly, so Director A is actually focusing upon diversification, and the director B is actually talking about acquisitions rather than moving into a different sector. So that's what they're focusing upon. Director C agreed with Director B but suggested that Checkup should consider relatively new pharma companies as well as uh, the Director C agreed with Director B but suggested that Checkup company should consider relatively new pharmaceutical companies as well as established companies. In her opinion, newer companies might be involved in R&D of innovative products, which could have high potential in the future. She has suggested that using real options methodology with traditional investment appraisals such as NPV could establish a more accurate estimate of the potential value of such companies. Now, the company has asked its finance team to prepare a report on the value of the potential target company for Shoro company before making a final decision. So we have got three types of directors who are actually suggesting a different ball game. All three are actually showing a different thing. One of them is actually of the suggestion that we should go for diversification. The other is of the viewpoint that we should go for acquiring established companies. And third is of the viewpoint we should actually consider acquiring those companies which are actually of our sector but not established, but in fact which have got higher amount of products under development stage. Now what next is there? It says Foshoro is a non-listed pharma company established about 10 years ago. The Foshoro was established about 10 years ago. It's a non-listed company. And initially, Foshoro grew rapidly, but this rate of growth slowed considerably 3 years ago. So the rate of growth rate has actually slowed down after venture capital equity backer exited the company by selling its stake back to the founding directors. The directors had to raise substantial debt of capital to buy back the equity stake. So what did the directors do? They raised a substantial amount of debt capital. Company's current debt to equity ratio is 6:40. This high level of gearing means that company will find it difficult to obtain funds to develop its innovative products in the future. The following financial information relates for Shoro. The sales is there, PBIT is there, interest is there, taxation is there, profit after taxes. It says in arriving at the profit before interest and tax for Shoro deducted tax allowable depreciation and other non-cash expenses totaling 112 million. It says it requires cash investment of 98.2 in non-current assets and working capital to continue its operations at the current level. Now, 3 years ago, Foshoro's profit after tax was 83.3 million, and this has been growing steadily to the current level. So this has been steadily growing to their current level. What is their current level? Their current level is actually, just hold on for a second, please. I think there's something wrong. Okay. So anyways, it says that this has been growing steadily to their current level. For Shoro's profit before interest and tax and its cash flow grew at the same growth rate. It is likely that this growth rate will continue for the foreseeable future if Fishora is not acquired by Chicap. It says Fishoro's cost of capital has been estimated at 10%. Now what next is there? It says once Chicap company. So what next is there? It says that once Chicap company acquires Foshoro, it is predicted that combined company sale revenue will be 4,200 in the first year, and its operating profit margin sales will be 20% for the foreseeable future. After the first year, the sale revenue is expected to grow at 7% per year for the following 3 years. It is anticipated that after the first 4 years, the growth rate of the combined company will be so and so. The combined company's tax allowable depreciation is expected to be equivalent to the investment needed to maintain current level of operations. However, as company's revenue increases over the 4 year period, combined company will require an additional investment in non-current assets of so and so. And then 0.64 per $1 increase for the next 3 years. It says it can be assumed that the asset beta of the combined company is the weighted average of the individual company's asset beta weighed in proportion to individual company's value of equity. It can also be assumed that capital structure of the combined company remains the Chicap's current structure, a debt to equity ratio of 30/70. Chicap pays interest on borrowing at so and so. Chicap company estimates that it will be able to acquire Foshoro by paying a premium of 30% of its equity value to Foshoro's shareholders. Other financial information is given, equity beta is given, asset beta is given. It says current government borrowing rate is 2%. That means the risk-free rate is 2%. And the annual market risk premium is estimated at 7%. So RM minus RF is estimated at 7%, which is actually too high. Now, it says both companies pay tax at an annual rate of 20%. Now, both companies pay tax at an annual rate of 20%, and Chicap estimates equity values in acquisitions using free cash flow to firm methodology. The BOD agreed that in future it's likely that Chicap will target both listed and non-listed company for acquisition. It is aware when pursuing acquisition, company would need to ensure that it complied with regulations such as mandatory bid rule and the principle of equal treatment to protect shareholders. That some listed companies may attempt to defend acquisition by employing anti-takeover measures such as poison pills and disposal of crown jewels. Now, what next is there? Let's actually talk about it. So first of all, we need to actually compare and contrast the reasons for the opinions held by directors A and director B and discuss the types of synergy benefits which may arise from the acquisition suggested by director B. Now let's talk about the various types of reasons that why are the directors actually suggesting these various things. Now when we talk about this March-June 2018, question number one. So what exactly is this March-June 2018 question number one indicating? Now let's talk. You see, the focus of Director A is that the company should focus upon the risk diversification. Now, in order to explain the concept that the Director A is actually suggesting, I'm actually going to recall a concept of portfolio theory. that what exactly is a portfolio theory. Now, when we talk about the portfolio theory, the concept of portfolio theory is like this, that when we talk about the portfolio theory, the concept of portfolio theory is that when we actually invest into multiple sort of companies, when we actually invest into multiple sort of companies, you're invested into pharma, you've invested into agri sciences, you've invested into, let's say, retail sector, you've invested into oil and gas sector, etc., etc. When you actually invest into these various types of sector, so what actually happens is that your risk is diversified away, your risk is spread over the various companies. Now, when we talk about the portfolio theories, the portfolio theory also suggests that when you actually try to create the number of portfolios, when you actually try to create number of portfolios, so basically what happens is your risk level actually goes down, but it goes down to an extent, and then what happens is it stays back constant at a certain level. So the risk which could not be diversified away is actually termed as unsystematic risk, and the one which could be diversified away, sorry, this is called systematic risk, and the one which could not be which could be diversified away is the unsystematic risk. Now, so what happens is, yes, unsystematic risk is reduced, Amartya. So basically what happens is the unsystematic risk is reduced or diversified away as we actually try to create the portfolios. So basically what happens is that the director A is of the viewpoint, and what is his viewpoint is, his viewpoint is that if we are actually gonna invest into the various other companies, then what will happen is the risk is actually going to diversify away, and that is actually going to be beneficial for the entity and for the shareholders. So it says compare and contrast the reasons for the opinions held by director A. So we have discussed the reason why director A holds this reason. So this reason is because his thought is that we would actually be able to diversify the unsystematic risks that do exist. Now, whereas the division B, now you need to understand this thing, that the shareholders of this company checkup are majorly institutional investors. And when we talk about the institutional investors, so what generally happens with the institutional investors is the institutional investors are already diversified. They're already diversified. They've already spreaded their risk. So basically, what happens is when you would actually want to diversify on your own, you would not be able to help these institutional investors much because they have already created their own portfolios and they've already been diversified on their own. So apparently, the thought that Mr. A or Director A actually has may not work out well because the shareholders are majorly the institutional investors, and it ideally fits onto the portfolio theory, ideally fits onto the institutional investors who already think about diversification on their own. Now, what next is there? Let's talk. Okay, now next talk. So similarly, when we talk about the director's B's viewpoint, so what is director B's viewpoint? Director B is of the viewpoint that we should focus on existing business and try to make maximum use of our presence in this industry. Because his viewpoint is generally that we would be able to have synergistic benefit. We'd be able to have synergistic benefits if we actually keep on focusing on this specific sector. So his viewpoint was that we would be able to have some synergistic benefits which may actually arise if we stay back in this specific sector. Now, what exactly are going to be the various synergies that may potentially arise if we stay back in our own sector? Now, when we talk about having synergies, so the synergies are generally speaking classified into three sectors. And what are those three sectors? Three headings, and they are actually the cost synergy, they are actually revenue synergy, and the third one of them is financial synergy. Now, what exactly is cost synergy? What is revenue synergy? What is financial synergy? Okay, so when we talk about the concept of cost synergy, the cost synergies would be like economies of scale, at the same time, greater bargaining power. The economies of scale could be with respect to production, could be with respect to the bulk buying, etc., etc. This could be the things. The revenue synergies could actually be that customers of Foshoro will become Chicap's customers, competition will reduce. So these are the things that might actually arise. And now, when we talk about the financial synergies, so they may not actually arise in this case. When you have got yes synergies, 2 plus 2 is equivalent to more than 4. So the financial synergies could actually be you can have accumulated tax losses, you can have spare debt capacity, etc., etc. So these are the things that would probably be there. So if I actually talk about these synergies, the synergies could be cost, synergies could be revenue, could actually be financial, etc. Now, in this scenario, we would have these synergies, and in addition to this, the additional synergies that may actually arise from this thing is the additional synergies could be at times you target. At times the target is undervalued company, as it helps achieve greater synergy. Usually targeting an undervalued company helps achieve a greater synergy. Um, yes, there's a downside to there's a downside, and that is actually the duplication of the functions. Um, okay, there are two queries from the students. One of them is Yusuf Habibi, Yusuf Al Habsi is asking that I also think eliminate the duplication of functions and cost synergies. Yes, the duplication of the function is also avoided because you now have got two companies which is now a bigger size as compared to the individual company. And since there are actually a lot of people who perform the same role in both companies, so few of them could actually be laid down. Resultingly, what would happen is that you would have lesser number of people and who are taking care of a greater number of transactions and the greater number of areas. The second thing is that the synergy could also arise when you target an undervalued company. Now, what do we mean by undervalued company? Now, what do we mean by undervalued company? Undervalued company actually refers to there may actually be the case that you have a company whose worth is actually whose one share's worth is $10. but the share is currently trading in the market at, let's say, $6. Now, when you actually buy a company which is undervalued, when you buy a company which is undervalued, so the advantage that it actually gives you is that in case if something goes wrong, because you've already bought something which was worth more than what you have actually purchased it for. So there could actually be two things that could arise. One of them is that if you actually keep it with yourself and you enhance the value a bit, you can keep it with yourself, you can sell it again, so that you can get good return out of that company. Or the other thing is basically that when there is a company which is undervalued, and if you actually minorly work on that company on a very minor stage, on a very minor levels, then that company actually reaches to its full potential and actually gives you a profit. So the thing is that an undervalued company is a potential synergy or a potential advantage of the acquisition strategies, because undervalued company means that the gain is ready to be available to be bought, and if you just bought it, that means you will ultimately have a gain. Okay, there's a question that bootstrapping, Yusuf, is a bit different. It's actually when you've got undervalued companies and those companies have got limited amount of resources. So, I mean, it's a bit different when you just focus upon the startup. Mariam Sana, I did not determine that there would be undervalued company in the scenario. I've just written down one point that the company, the acquisition may be that you might actually have a company which is underperforming in your sector. And if you acquire it, then you will actually gain by having an undervalued company on your board. Now let's just move forward. Let's just discuss further. So this is actually part A to the question where we did discuss that how using the real options methodology what are the basically reasons that Mr. A or the director A and the director B are giving such sort of suggestions. Now the next situation is, let's discuss how using real option methodology. What is the question saying? Discuss how the real option methodology in conjunction with NPV could establish a more accurate estimate of the potential value of company as suggested by director C. Now let's see, what exactly do we mean by real options? Okay, let's talk about the concept of real options. Now, what exactly do you mean by real options? Let's actually discuss about these real options. There is a concept in your course which is actually the Black-Scholes option pricing model. Black-Scholes option pricing model is a model that is used to value an American style option. So when we have to value an American style option, we use the Black-Scholes option pricing model. So what is the Black-Scholes option pricing model actually used for? The Black-Scholes option pricing model is used for valuing the American style options. Now, what are American style options? The American style options are sorry, the European style options. And what exactly are the European style options? The European style options are the options which are exercisable on the maturity date. Now, if I talk about this Black-Scholes option pricing model, so we actually don't need to actually use the Black-Scholes model right now. But when you study Black-Scholes model, you do study another technique which is called the concept of real options. Now, what is the concept of this real options? Let's actually discuss. Now, when I talk about the real options are actually of these four types, which I've actually mentioned in here, which are option to delay, the option to expand, option to redeploy, and at the same time there is this option to withdraw. So these are the four categories of the real life option: the option to delay, option to expand, option to redeploy, and option to withdraw. Now, what do we mean by these real life options? You see, what happens is that when you perform the NPV calculation, now let's understand this concept. Now, at times what happens is when you actually perform this calculation for the NPV, you might actually come across a situation where you have got a negative NPV. Now, there could be a possibility that it's not necessary that you should undertake. For example, now is 1st January 2019, and I've calculated the NPV on 1st January 2019, and it turns out to be a negative NPV project. Now, what happens is in real life, what can happen is you can wait for some time, you can wait for 6 months, you can wait for a year or so, and then you can actually undertake the project after that. And then you can actually undertake the project after that. Now, so what is going to happen if we are actually going to wait for some time rather than undertaking the project then and there? What is actually going to happen is that there might actually be circumstances which may become favorable, which may become the circumstances of your choice. So you are having a negative NPV project right now. It might be a possible that material prices are high right now. It might be a possibility that the labor is not available right now. There might actually be a possibility that the inflation rate is too high. So there could be multiple possibilities. So there might actually be the case that if we wait for some time and we undertake a project at a later stage, then the same project may actually turn out to be a positive NPV project. So if you have such an opportunity where you can wait for some time, such an opportunity is termed as option to delay. Now, what is this option to delay? It's an option to delay the undertaking of a project so that you could benefit from the favorable movements in the values after that. So that you can benefit from the favorable movements in the values after that. So what is it? Option to delay. Now, at times what happens is there is another option which is called option to expand. Now, what do you mean by option to expand? You might actually get into a sector. Initially, you may actually be loss making, but once you get into a sector and once you actually get to know about that sector, then you might potentially have an opportunity to expand, to actually increase the size, to actually penetrate more into that specific sector. So that's actually the option to expand. Like for example, you want to enter into pharma manufacturing. Now, so if you want to enter into pharma manufacturing, that means you need to have links with the people in the pharmaceutical sector. That means you need to have links with the people in the pharmaceutical sector. Okay. So I'm repeating it again. Let's say what is written after sector? Loss making. Now, I'm gonna repeat it again. Let's assume that you want to start pharmaceutical manufacturing and you don't know many people in the pharmaceutical sector. So what exactly are you gonna do? So if you don't know many people in the pharmaceutical sector, so one of the options that you can actually go for is that you might not directly go on to manufacturing of the pharma sector. You first try and understand the pharma industry. You try to have develop the contacts. You try to have develop the relationships, and for that, what you do is that you enter into a pharmaceutical distribution in the initial phase. Once you enter into pharmaceutical distribution, then you realize that what exactly the industry is all about, and then you can actually exercise the option to expand further into that specific sector. So that is called option to expand. What is this option to expand? You go to an industry, you go to a sector, you go to a location, you start off with a smaller scale, and then you expand yourself, you diverse into it. So that is called option to expand, and that exists in the real life. So maybe one of the initial venture may be loss making, but the subsequent ventures could actually be profit making. Okay. The third situation is basically we have talked about the option to delay, we've talked about the option to expand. The third one of them is option to redeploy, and the fourth one is option to withdraw. Now, what do you mean by option to redeploy? Option to redeploy is basically use the same resources for some other purpose. That is called option to redeploy. Now, I'm going to give you an example of what exactly is an option to redeploy. Now, you see, the option to redeploy and the option to withdraw are actually put options, and the option to delay and option to expand are actually call options. Now, what do you mean say that call option and the put options? Option to redeploy is a sort of option of coming out of a sector. Option to withdraw is also sort of a coming out of a sector, and option to delay is getting into a sector. Option to expand is getting into a sector or getting into a business. Now, as I did mention earlier also that I serve as the chief executive of a ACC learning partner. So I'm going to share with you that we are based here in Pakistan, and in Pakistan we have got three campuses across the country. So basically, one of the campus, the original campus, was in Karachi, and we got an opportunity to open up a campus in Sakkar. Sakkar is basically a suburban city in Karachi, not very developed, but it's actually third largest city in the province of Sindh. So it's a sort of a suburban area, not a rural area, not an urban area, but a suburban area. So we actually had an opportunity to open up a campus there. So what we did was we took that decision. We went into that. We went on to the Sakkar venture, and when we went into the Sakkar venture, we people actually did told us that you might actually end up being a successful because nobody has ever gone on to that market and nobody has ever tried and tested that market. So it was a completely virgin market. Nobody had, for sure, nobody had ever tried it. Nobody had ever tried to explore it. And when we actually went on, I myself was a bit confused that are we going in the right direction? What if it does not work out? So I figured out one thing, that we have an option to redeploy. Now, what is that option to redeploy? The option to redeploy is that I can probably revert back the entire furniture, the entire facilities that are there for the teaching. Obviously, the construction or the development for the classrooms that we did could not be redeployed back to Karachi. But the furnitures, the projectors, the boards, and etc., that could all be redeployed to some other campus which was already in existence. So that's what the option to redeploy is, when you are able to utilize your resources in some other purpose. Okay. There is a student who is actually given an example that the steel sector, the steel manufacturer can use his premises for the oil and gas or for the oil refining or for the oil processing. So yes, that could also be the redeployment. So redeployment is simply when you're able to utilize the same assets for some other purpose. That's redeployment. The third one of them is basically the option to withdraw, which is put option, which is an option to sell. That if you do have an option to sell something, then that's an option to withdraw. So if you actually enter into a sector and with an option that you can come out of it, then actually that's an option to withdraw. So at times you might not be very profitable during the time period that you run that project, but by the time you come out of it, you might end up getting a very good amount. So that's an option to withdraw. Now, the examiner is asking in this part of the question that discuss using the real options methodology in conjunction with NPV could establish a more accurate estimate of the potential values of companies as suggested by Director C. So if we talk about it, so yes, we need to explain to the examiner first that what exactly do we mean by the real options. So real options are when it comes to the real life, you can have the multiple options, and the multiple option is the multiple directions or the multiple strategic choices that you can have. Now in this specific scenario, what is actually going to happen is that if you go for director C's suggestion, if you go for director C's suggestion, then what is actually going to happen is you will be investing into small companies and you will have the option to expand. Now why would you have the option to expand? Because those companies are underperforming, those companies have not actually been able to achieve a very good performance. But they have the platform ready, they have got background, they've got the base ready, so you could just simply take them up, you could sub them, inject some funds into it, and you could take it to the next level. Okay, now next it says estimate the current value of Fushoro, estimate the equity value arising from combining Fushoro with Chicap, evaluate whether acquisition would be beneficial or not. So there is this 6 plus 11, 17 plus 7, uh 24 mark requirement about this specific uh, Amartya, when you are asking option to withdraw actually means option to sell. Option to withdraw actually means option to sell. Now let's talk about valuation of this company. So we're gonna talk about it, that how exactly are we gonna perform the valuation of these companies. Let's discuss. Okay, so what we need to do is that we need to calculate the equity value of Fushoro company. If I talk about this company, the Fushoro company, we are actually being given the information by the examiner. And amongst the information, there are key information that is available to us. And what are those key information that are available to us is basically, first one of them is we are actually being given the gearing ratio, which is 60/40, the debt to equity ratio. So it's actually 60 upon 60 plus 40. So it is actually zero point 0.6. That is the debt upon debt to equity ratio, or you could actually say that the gearing of the company is 60%. Furthermore, we've been given sales, PVIT, interest, tax, profit after tax, etc. It says in arriving at profit before interest and tax, it deducted the tax allowable depreciation of 1 and 2 and requires cash investment of so and so 3 years ago. The profit after tax was so and so. And if the profit after tax was so and so, this has been growing steadily, and the entity's cost of capital has been estimated at 10%. Now, how would we calculate? First of all, you need to establish the growth rate over here. Now, how would you actually establish the growth rate? So we are actually being told that is 83.3 multiplied by 1 plus g power. Power 3 is equivalent to 91 million. How much? The 91 million. So what we could do is that we could say 1 plus g power 3 is 91 divided by 83.3. So resultingly, you could calculate the growth rate using this geometric mean method. So how much does the growth rate turn out to be? Okay, so it's approximately 2.99 or 3%. That's what the growth rate is. 3% is what the growth rate is. Now, so the first thing is we have got the growth rate, which is 3%. Now, let's talk about these free cash flows to firm. That how would we calculate the free cash flows to firm for this company? So we do have the profit after tax also, and we have the profit before interest and tax also. You can calculate from the profit after tax also, and you can calculate from the profit before interest and tax also. Both of the calculations would result in the same thing. So let's just start off. If I actually start off with 91, the profit after tax, what I need to do is that I need to add up the after tax interest into it. So after tax interest is actually your interest multiplied by 1 minus t. So the interest expense over here is 78.6 multiply by 1 minus t. So what is this 1 minus t? So we need to have the tax rate. And the tax rate that we have here is what? Are we being given the tax rate? I'm probably missing out the tax rate somewhere. Um, okay, it's actually 20%. So it's going to be 78.6 multiplied by 1 minus zero point 0.2. So it is going to be 62.88 that we need to add up because the after tax interest needs to be added up. So the 62.8 needs to be added up. And then we have is basically we are being told that the company will have a tax allowable depreciation and other non-cash expenses totaling 112, and it says it requires a cash investment of 98.2 in non-current assets and working capital to operate the operations at current level. So basically what happens is the non-cash expenses etc 112 needs to be added back, and what needs to do is that we need to deduct the investment, and the investment which needs to be deducted is 98 point, it's 98.2. 98.2. Now what next is there? It says so these are the things that we have. So we do actually end up getting the free cash flows to firm as what? So it turns out to be 167.68 million. So it turns out to be 167.68 million. Now what we need to do is that we need to calculate the value of this company. So how would we calculate the value of the company? So value of the company is the present value of the future cash flows discounted using the relevant rate. The cash flows are expected to grow by 3% for an indefinite period because they are expected to grow at the same rate. And what we need to do is that we need to actually divided by 10%, which is the cost of capital, minus the 3%. Resultingly, how much is it going to be? So we have 2467.3 million as the value of the firm. So the free cash flows to firm is 2467. Now, we are actually being told that the debt to equity ratio of the entity is 60 upon 40, which turns out to be debt upon debt plus equity is basically 60% is equivalent to 60%. So now when we have the entire value of the entity as so this actually means that you have got 60% as a debt and you've got 40% as an equity. So resultingly, what is actually going to happen is that you would say that the value of equity will be 2467.3 multiplied by 40% because 40% of the entity is worth as equity. So it's going to be multiplied by zero point 0.4 gives you 986.9 or 987 million as the value of the equity. So what is going to be the value of equity? 987 million will be the value of the equity. Is everyone okay till here? So we have established the value of Fushoro company. So if everyone is okay, I can then move forward and I can discuss further. Okay, Amartya, your question is that 112 into 80% should be added. No, it's not 112 into 80%. It's not like that here. It's actually simply we're not saying that we're not going to be claiming them. We are going to be claiming them while calculating the tax. And the tax impact will not be affected because of this, because you see what happens is already the tax has been calculated by incorporating this 112 and its tax allowable depreciation. So it's just that we are adding them back. The reason behind that is we are saying that this is non-cash expense that's been added, that's been deducted. There's a student who's asking, Sumbul Khan, she's asking that can you explain the D upon D plus E step? Okay, so basically we are being told that the debt to equity ratio is 60-40. So if the debt to equity ratio is 60-40, that means if you say it this way, 60 divided by 60 plus 40. So that means 60% of the business's worth is based on debt and the remaining 40% is based on equity. So all that you need to do is that you need to simply multiply this free cash flows to firm with the 40% to you end up getting the value of equity. Okay, so we are done with the value of this company, which is Fushoro. What we need to do is that we need to calculate the equity value from combining Fushoro with Chicap company. So that's what we need to calculate. Now, if we are going to be calculating this value of the combined company, so the important thing is there are various steps that need to be done in order to calculate the value of this combined company. And what are those various steps that we actually need to do? Uh, we need to calculate the revised weighted average cost of capital, etc. Before we can go for it. So the second requirement of the question is the value of combined company. What do we need to do? We need to calculate the value of combined company. Yes, Amartya, that's what I've done. Haris Tasneem is asking that where did we get this 3% growth rate? So there was something mentioned in the question, and what was mentioned that 3 years back the entity had a profit after tax of 83.3, and recently the entity's profit after tax is 91. And it says that the profit after tax has grown constantly over this time period, and the rate at which the profit after tax has grown, the same rate has been applicable to the growth rate of the other cash flows, etc. So we established 3% as the growth rate using this specific information. Okay, so if we need to calculate the value of the combined company, first of all, we need to have the free cash flows to firm. Those free cash flows to firm needs to be calculated. Once we are done with free cash flows to firm, then we can actually move forward. Okay, so we have got year 1, 2, 3, and 4. These are the 4 years that we have. Now, what next is going to be there? What we need to do in this specific scenario is we need to calculate the free cash flows of the combined company. That's what we have to do. So we are being told that the company's sales revenue will be 4,200 million in the first year, and its operating profit margin on sales will be 20% for the foreseeable future. So that means we are actually being told that sales of the company are going to be 4,200 million. The PBIT will be at 20%. So it is actually going to be this in 2.2. This is 840. Now what else is there? It says after the first year, the sales is expected to grow at 7% for the following 3 years. So it's going to be at the rate of 7%. And the operating profit margin is expected to be the same for the foreseeable future. So this is what the operating profit margin is going to be. What next is going to be there? So we need to, because since we need to calculate the free cash flows to firm, um, since we need to calculate the free cash flows to firm, so what we are going to do is that we're going to apply the tax directly to it at the rate of 20% because the tax rate is also 20%. So if you're going to apply the tax to it, which is going to be 20%, so you don't have to actually calculate the PBIT. You don't have to calculate, you don't have to add back the after tax interest. It's just that PBIT multiplied by tax directly. That's an alternate way of doing the free cash flows to firm. Then we are being told that the company's depreciation and investment needed will be the same. So if I deduct the depreciation, let's say 100, I need to add back the non-current asset investment, which is 100. So it's better that I don't do any of these. So it's better that I don't do any of these. So that's why I'm not actually going to write down anything over here. Then the next thing is additional investment. Additional investment that is needed is actually going to be 64. It's going to be 0 point additional investment required in the first year and then so on. So what the additional investment is going to be? It will be 200 million in the first year and then 64 cents per $100 per dollar. So basically what is going to happen is we'll have negative 200, and in the remaining years we will have 0.64 multiply by the increase in the sales revenue. Okay, for those of you who are not aware about this formula, what I did was I simply calculated the opening and the closing sales and the difference between that sales multiplied by 0.64. Okay, so that's how it is. Now, what next is there? The next situation is we will have the free cash flows. We'll have the free cash flows. Now, when we talk about the free cash flows, it is actually going to be this. So we'll have these free cash flows. Now, these are the free cash flows for the first. These are the free cash flows for the first 4 years. And what we now need to do is that we need to calculate the present value of these free cash flows, and then we need to actually calculate that how exactly are those free cash flows gonna move forward. So now what I would want you people to do now is that I would want you people to now calculate the discount rate. Now calculate the discount rate which is to be used. You need to calculate it on your own. I'll give you 3-4 minutes. Okay, so do we have any answers to the WAC? Okay, approximately 8%. Is everyone okay with the calculation of this WAC, or there are people who are not able to understand? Please let me know if everyone is okay, then I am not going to invest my time into it and I would rather focus on other things. So if you are okay, then we'll actually move. Okay. No, I need to know the WAC. Okay, I'm actually gonna go and discuss this WAC because there are few students who are having problems with it. Now, so let's actually start discussing about the weighted average cost of capital. That how we calculate this weighted average cost of capital. What are we being told? We are being told that the asset beta of the combined company is the weighted average. What are we being told? That the asset beta of the combined company is the weighted average of the individual company's asset betas weighed in proportion to the market value of equity of each company. Now, it can also be assumed that capital structure of combined company remains at so and so, debt to equity ratio so and so, so and so, so and so. Now, so if I actually talk about it, we were actually being told in the initial part of the question the value of this company, which is Chicap company, and it was 12,600. So the value of the Chicap company was 12,600. Now, see, how do we calculate this? Is that okay? The asset beta of the both the companies is going to be the combined company asset beta is going to be 0.8, which is the value of Chicap company asset beta of the Chicap company divided by Chicap company value of 12,600 plus 987 the value of Foshoro company, plus we have 0.95 as the asset beta for Fushoro company. So it's 0.95 the asset beta for Fushoro company multiplied by 987 divided by 12,600 plus 987. So resultingly the asset beta comes out to be what? Okay, 0.811. The students have calculated answer. The 0.811 is the weighted average asset beta. Now what we need to do is that we need to actually re-gear this beta. What do we need to do? We need to re-gear this beta. Generally speaking, the formula for the asset beta is equivalent to, it's the asset beta is equivalent to equity beta multiplied by E upon E plus D 1 minus T. Now here what we are actually going to do is that we need to calculate the equity beta. So you'll have the asset beta as 0.811 multiply by 0.3 plus 0.7 into 0.8 divided by zero point 0.3. So you'll have the revised equity beta. How much is it? Okay, so this is 1.089. Now when you have this equity beta, what are you going to do next? The next thing that we are actually going to do is that we will use this information to calculate the cost of equity. So in order to calculate the cost of equity, the risk-free rate is actually 2%. The risk-free rate is 2% plus 1.089 multiplied by market risk premium. And what is the market risk premium? So if I talk about the market risk premium, that is 7%. So the market risk premium is actually 7%. So resultingly, if I talk about it, it turns out to be 9.623%. Now, if the cost of equity is 9.623%, we need to use this cost of equity in order to calculate the weighted average cost of capital. So the WACC is going to be what? Are we being given the cost of debt? It says the entity currently pays interest of 5.3% on its borrowing. So if it pays interest of 5.3% on its borrowing, then how would we actually go about all this? Is that we'll say 9.623% into 0.8 plus 5.3% into 80% into zero point 0.2. So it turns out to be what? 8%. Sorry, into 70%. Into zero point 0.7 and into zero point 0.3, because the revised gearing ratio is going to be 30%, not the 20%, not the 60%. So we have the WACC as 8%. Now what are we being told? So what we would do is that we would calculate the present value. There's a discount factor at the rate of 8%, and we would have 1 plus power minus. So we have the present value of these cash flows as 1789 or 1790. So what do we have? We have, if we need to calculate the value of the combined company, it's actually going to be year 1 till year 4, 1790, and year 5 till infinity, what is going to be happening? It says it will grow by 5.6% per year. Take 7.8 into 1.056 divided by 8% minus 5.6% multiplied by 0.735. So how much does it turn out to be? 19658 or 19630. So it is 19630 plus 1790 gives us a total value of 21,447. 21,447 is approximately the value. There are rounding off issues involved over here. Okay, so we're done with this. Now we need to move forward and we need to discuss further. So the last requirement of the question is, in fact, no, there are two more requirements. It's a 50 mark question. So obviously, it was supposed to take time, but I'm glad that we are able to actually do this question in full almost, because this actually helps us understand that how do we actually answer the question in the exam also. Now, so the requirement was to calculate the market value of the equity of the combined company. So how much is it going to be? The combined company would have a gearing of 30%, so the equity is going to be 70%. So this means that it is actually going to be 15013. 15013. What is it going to be? 15013. There is a rounding off element involved over here. There's a rounding off element involved over here. So there is going to be a bit of a difference. Now what next? The next requirement of the question was that evaluate whether the acquisition of Foshoro company would be beneficial to the Checkup company's shareholders and discuss the limitations of the valuation method used in C1 and C2 above. Now we need to calculate whether this Foshoro company's acquisition would be beneficial to Checkup shareholder. Now, how would we calculate the value, whether it is beneficial for the Checkup company shareholder or not? So let's actually talk about it. So how would we calculate? We would calculate the individual company value was Chicap was worth 12,000. Chicap was worth 12,300 or 12,600. And Fushoro company was worth 987. Resultingly, if we combine both these companies together, it's going to be 12,600 plus 987. It's 13,587. 13,587. And when we have got 13,587, this is going to be 15,013. So 13,587 minus 15,013, this gives us 1426. This gives us 1426 as the increase in the value of the combined company. Now, the question's requirement is that how much is this going to be beneficial for for the Fushoro company's shareholders? That's what we need to establish. That is this going to be beneficial for the Fushoro company's share for the Fushoro for the chip company's shareholders or not? So you see, um, we were being told in the initial part of the question, and that was we are being told that the company Fushoro will be acquired at a premium of 30% of the equity value. So, resultingly, if I summarize this whole, it is actually going to be 1129.9 or 1130, which is the benefit attributable to the shareholders of Chicap company. The benefit attributable to the shareholders of Chicap company. Okay, now let's actually summarize the last part of the question. And the last part of the question is basically we are going to discuss few more concepts in this last part of the question. And this last part is discuss how the mandatory bid rule. What is it? It says discuss how the mandatory bid rule and the principle of equal treatment protects shareholders in the event of their company facing a takeover bid, and discuss. So what I would do is that I would split the question requirement into two parts. And the first part is basically the discussion of mandatory bid rule. And the second one of them is principle of equal treatment. Now, what is this mandatory bid rule actually means? Now you see, for example, there's a company where a 90% shareholding is held by somebody and 10% is held by somebody else. And we acquire 90% of that company. We acquire 90% of this company. So the mandatory bid rule actually means that that we should offer these existing non-controlling interests. We should offer these existing non-controlling interests, the 10% shareholders, the right to sell their shares and exit from their investment. So basically what happens is the mandatory bid rule actually refers to the scenario where you need to offer this existing shareholders a right to sell their shares and exit from the company if they are not happy with this takeover, rather than making them suffer if the company is not listed, like in the Fushoro's case. Fushoro company is not listed in this case, so how would the shareholders take an exit? Now, the second thing is the principle of equal treatment. Now, what is this principle of equal treatment? So when we talk about the principle of equal treatment, that means that these shareholders, the non-controlling interests, are also offered same price as controlling interest is. So the way the controlling interest is being offered the price, the same way the price is being offered to the same way the price is being offered to the shareholders of the non-controlling interest also. That means they're being offered the fair price. So these are the two things, that they are being given a bid, they've been given a bid that if you want to sell, you can sell at a price which is equal to the price at which we have bought the controlling stake. What next is there? So that's first part of the question. Now it says, and discuss the effectiveness of the poison pills and disposal of crown jewels as defensive tactics against hostile takeover bids. Now, what is this crown jewel? Now, crown jewel is basically selling of attraction. Now, disposal of crown jewel means selling of the attraction. Now, when we talk about selling of the attraction, so what exactly does it mean? Basically, what happens is at times there is an acquirer who wants to acquire your company, and the attraction in your company may be your intangible, maybe your patent or something like that. So, the crown jewel tactic or the crown jewel strategy of basically defense is that you sell off the attractive asset or the valuable asset of the entity, which is the major source of attraction for the acquirer. So, you sell off that asset. That's the strategy. Now, what's number two? Number two is the poison pill. Now, what is this poison pill? Uh, this poison pill, these are the typical terminologies used when the M&A transactions are being done. So, the poison pill is actually that what you do is that when we talk about the use of the poison pill, so under the poison pill, what we do is that the existing shareholders in the entity are being issued option to buy additional shares. The existing shareholders have option to buy at discounted price shares in the company which is the target of the hostile takeover. So what happens is the acquirer actually the company becomes unattractive for the acquirer. Why? Because he would actually think that if I need to buy this company, I would actually have to buy additional. I would actually have to buy additional shares from the people, because right now the shareholders may have 3 million shares, but as soon as we buy some shares, the shareholders have the right to buy additional shares for XYZ amount. So what is going to happen is if they do exercise their option, that is going to dilute the company's shareholding. So it becomes expensive to buy this company. So yes, they could serve as the strategies, but obviously there is actually a conflict between, because what happens is the management doesn't want the company to be sold. The shareholders might actually be happy disposing of their shares at a premium, because generally speaking, what happens is whenever a hostile takeover bid arises, there is usually a premium involved. There's usually a premium involved in that hostile takeover bid. So the shareholders would be happy, but the management is obviously not going to be happy with this. So that marks the end of this question, alhamdulillah. So we've done with this 50 mark question, which is question number one, and have completed the entire evaluation concept over here. So if I summarize, March June 2018, question number one we did already. Question two we also did. That was the first ever question that we did. Question three we've also done. So it's the question number four that we did not actually do. Question number four that we did not actually do. We would see if we need to actually go through it or not. But for the time being, the next question that I'm actually going to move forward is going to be the question that we actually didn't complete in yesterday's class. Amna Ahmed, poison pill actually means that the target company, like for sure in this case, may actually give an option to its existing shareholders that if an acquirer acquires say, 20% or 30% shares in the company, then you can buy additional shares in the company at a price which is a discounted price on the market. So that could actually be the case. Okay, what I'll do is that I'll have a short break of 3-4 minutes, and in the meantime, if anyone has any questions, you can type down and I would try and answer them. So you'll have a break till 7:47 p.m. and then we'll go on for the international investment appraisal area. Option to switch is a put option. Yes, option to redeploy and option to switch are the same things, Mariam. Okay, Mustafa Kamal, don't worry. I have a solution for you people. I'll inshallah share that. Just don't worry about that. Okay, ji. Now let's actually move forward. So the next step is going to be we started doing one of the questions in the yesterday's class that was about the interest rate swap. We only did some part of that question, but we did not complete the question. So what I'm actually going to do is that I'm going to take up things from that specific question and I'm going to discuss further. Okay. Yes, we're not going to be doing currency swap, but we're going to be attempting this specific question which we left halfway in between. So basically there are a few things that I want to actually discuss with respect to this question, and then we can move forward. Now you see, I'm going to discuss the basics of international investment appraisal, and I'm going to discuss the basics of international investment appraisal. Now, what exactly is with respect to the international investment appraisal that we need to discuss? So let's actually talk about it. You see, what happens is you may be based in UK and you would have invested in a UAE company, and you would have invested in a Japanese company, and you might have actually invested in a Malaysian company. So the problem that actually arises is we are based in UK. We have an option, uh, and we've got various options. We have got positive NPV projects which have got NPV in terms of pound sterlings, and we do have investment opportunities of moving abroad and going into some foreign country and then investing there. So for example, there's a UAE company where we have a AED $1 million positive NPV project. Then in a Japanese company, we may have Japanese yen, let's say 2 million Japanese yen project. In the Malaysian currency, we may have a Malaysian ringgit zero point 0.7 million project. So there could be various projects that could actually be available to us. Now, how would as we decide as an entity that which project should we go for? So it's important that we convert all these NPVs into the pound sterling, because once we convert them into pound sterling, we can have a better idea that is it worthwhile compared to the investment that we have available in UK. Now, so the biggest problem in dealing with the foreign currency investment is basically the foreign exchange, is the foreign exchange. Now, because you would have the cash flows in year 1, 2, 3, 4, etc., and those cash flows would actually be in the foreign exchange. So now if you would have the cash flows which would actually be available in the foreign exchange, so how exactly are we going to hedge against those? How exactly are we going to calculate the NPV using those cash flows? So there are actually two ways of doing it. There are actually two ways of doing it. Now, what are two ways of doing it? What happens is that you need to convert all cash flows into own currency using relevant exchange rate. So what you need to do is that you need to convert all the cash flows. You need to convert all the cash flows into the own currency using the relevant exchange rate. And the second thing that you actually can do is that once you've converted them into the relevant exchange rate, then what you need to do is that you need to discount using the local weighted average cost of capital. So one of the ways of doing it is you convert all the cash flows into the local currency, and then you discount using the local weighted average cost of capital. The other way of actually doing it is You discount foreign exchange cash flows using foreign WAC. You discount foreign exchange cash flows using the foreign WAC. And then you convert the NPV in foreign currency using a spot exchange rate. You convert using the spot exchange rate. Now, let's talk that how do these things actually go about. So basically, I have told you that you have an option: either you convert all cash flows into the own currency using the interest rate relevant exchange rates, or you discount using the foreign exchange cash flow using the foreign WAC. Now, when we talk about this concept of relevant exchange rate, what exactly do you mean? When we talk about this concept of relevant exchange rate, what exactly do you mean? Now let's talk. When we talk about the relevant exchange rate, this means the year one exchange rate for the year one cash flow, year two for year two, year three for the year three. Now, how would we calculate? How would we get these exchange rates? Let's talk. So these exchange rates could be calculated using the purchasing power parity, or they could be calculated using the interest rate parity. Now, when we calculate the purchasing power parity, it's the spot rate multiplied by 1 plus inflation in the local divided by 1 plus inflation in the foreign currency. Now, one thing that you actually need to understand is one thing that you actually need to understand is uh, it does mention in the numerator inflation in local, inflation in foreign. But you need to understand that if the exchange rate is dollar upon pound, it has to be the US inflation upon the GBP inflation. If it is pound upon dollar, the inflation is going to be UK inflation and divided by the US inflation. So you need to understand this. And similarly, when we use the interest rate parity, so in the interest rate parity, what we use is we use the interest rates rather than interest rate local, 1 plus interest rate local divided by 1 plus interest rate foreign. So this is what we do. Well, it does not depend upon direct, indirect, whatever the code is. You just need to figure out that what exchange rate is actually mentioned in the numerator. So you just use that country's currency. So you would not actually have to confuse yourself with the direct, indirect code over here. Now, what next? Now, let's talk about the currency swap. Now, what exactly is a currency swap? So let's just talk about it. Let's say okay, there is a confusion amongst the people that what is used in numerator, what is used in denominator. So my point is that you just need to figure out if the exchange rate is quoted as dollar upon pound, then that means US inflation would be in numerator and UK inflation would be in denominator, even if it's a direct code or even if it's an indirect code. Now, number two, if it says pound upon dollar, all that you need to do is that UK in numerator, US in denominator, that's it. Okay, now let's talk about the currency swap. Now, what is the currency swap? The currency swap is actually understood well in this way that assume that there's a company which is based in UK and there's a company which is based in Malaysia. Now, the UK company wants to invest in Malaysia and the Malaysian company wants to invest in UK. Now, what is actually going to happen is that there's going to be this initial investment which will flow from UK to Malaysia and from Malaysia to UK. Similarly, every year there is going to be dividends from UK to Malaysia, and dividends at the end of the project there is going to be principal also. The same goes for the other way around also. There are going to be dividends and there are going to be the principals. Now you do know that whenever you transfer the currency from one country to another country, so what happens is that on the transfer of the currency there is actually a transaction cost. There is actually a transaction cost that we incur on the transfer of the currency. And in addition to the transaction cost that we incur on the transfer of the currency, what we actually do is that, so I'm going to mention it here, we do incur the transaction cost on the transfer of the currency. Furthermore, there is a exchange rate loss that we incur also because of the currency spread, because of the dealer margin, because there are two rates, one of them is the buying rate, one of them is the selling rate. So we usually end up with a rate which is not a beneficial rate for us. Now you see, so what these company do is that they decide amongst themselves that the UK company will actually give the funds to the Malaysian company, and the Malaysian subsidiary would give the funds back to the UK company. And similarly, the same thing was going to happen over here also. So resultingly, what would happen is this whole transfer would actually be avoided. This whole transfer would actually be avoided, and the currency would actually be transferred or exchanged between the Malaysian subsidiary and the UK parent, and the UK subsidiary and the Malaysian parent. And what would happen is the currency would not have to cross the international boundaries, and it would be transferred locally only, and you would avoid any exchange rate risk, you would avoid any credit spread or the dealer margin, and you would simply be exchanging the currencies. That's it. And an exchange rate is also predefined at a predefined exchange rate. Now, the question mark is the investment. The question mark that arises is the investment amount can differ. The the residual value can differ. The dividends amount can actually differ. These all things can actually differ. Now, so basically, if all of these things are going to differ, then how would we have a currency swap? So what happens is there is a notional amount that is agreed between the parties. Now, what do we mean by agreeing a notional amount? Notional amount means an amount which is actually an assumed amount, a deemed amount that's actually termed as a notional amount. Okay, I hope this is okay now. Okay, so this is how the currency swap actually operates. Now let's talk about this question. So what we are going to do is that we're going to talk about this question, and we'll see what will happen. Now see, we were an international transport operator based in Eurozone, and we've been invited to take over rail operating franchise in a country called Vertonia, where local currency is the dollar. Previously, this franchise was run by a local operator in Vertonia, but its performance was unsatisfactory, so the government withdrew the franchise. Now it says Barriex will have to pay $5,000 million for the rail franchise immediately, which is year zero. Government has stated that Barriex should make an annual income from the franchise of 600 million of the next 3 years. So if it's going to be 600 million in each of the next 3 years, then it says at the end of the 3 years, the government in Vertonia has offered to buy the franchise back for 7,500 million. So the residual value is 7,500 million. If no other operator can be found. The exchange rate as of today is this and this. The predicted inflation rates are as follows. So you've been given the Eurozone inflation, you've been given the Vertonia inflation. The Barriax Company Finance Director Omar Yusuf is asking how would they agree the exchange rate? So the exchange rate is actually agreed by mutual consensus, by mutual discussion. Generally, it's the spot rate as of today on the on the date when we enter into a hedging relationship. Okay, so now it says that Bariak Company's finance director has contacted its bankers with a view to arranging a currency swap, since he believes that this will be the best way to manage the financial risk. Now, the swap would be for the initial fee paid, which is 5,000 million, with a swap of principal immediately, and in 3 years' time, both these swaps being at today's spot rate. The swap is going to be at the today's spot rate. Now, what next is there? It says the bank would charge an annual fee of so and so in order to provide Berry Export with an alternative hedging method to consider. FD has obtained the following information about an OTC options in Vertonia dollar for the company's bank, etc. Now we're being told calculate the estimate annual percentage saving. We did actually calculate. It says evaluate NPV and calculate the gain or loss arising from the swap arrangement. Now let's actually talk about part B of this question. Part B, requirement number 2 of this question. Okay, now what we are going to do is that we're going to perform the calculations in this scenario, and the calculations are going to be performed like this. What would we have? We would have this amount, exchange rate, amount in terms of GB, amount in terms of euro, discount factor, present value. The relevant discount rate in this scenario is what? Is 14%. Okay, so we have a 5,000 outflow. Then there is a 600 inflow, 600 inflow, 600 inflow in the year 1, 2, and 3. And then there is actually 5,001 and 2,500 another. Now, how would you, what is the reason for actually splitting the receipts in the year 4? There is a specific reason because the amount is subject to a swap contract. The amount is subject to swap contract. Now, what is it going to happen? So what we need to do is that we need to calculate the exchange rates. We need to calculate the exchange rates at various time periods. Now, okay, so the exchange rate is mentioned like this: euro upon dollar is equivalent to 0.143. Is equivalent to 0.143. It's mentioned like this. So basically, what would happen is when we calculate the forward rate, when we calculate not to the, okay, just wait, Amartya, just wait, just let me actually do it so you will understand what am I doing. The exchange rates that we have is euro upon dollar. It's 0.143. Now we'll have, this is the spot rate. This is spot rate. Spot rate. Then we'll have year one. Then we'll have year two. Then we'll have year three. So how is it going to be? This 0.143 multiplied by 1.06. Why? Because the Eurozone inflation will be in numerator, divided by 1.03. Why? Because the Vertonian dollar will be in denominator. So it's 0.1471, 0.147165. Then we'll have, okay, the next year is going to be, the Eurozone inflation is 4% and the Vertonia is 8%. So you'll have 4 and you'll have 8% here. And then the next year is basically 3 and 11%. So we'll have this conversion rates like this. Now, if you want to convert them into 3 decimal places, you can convert them. If you don't want to, then that's fine. So what do we have? We have the exchange rate as a spot rate of 0.143. Then year one, we have exchange rate of this. Then year two, we have exchange rate of this. Then year three, we have exchange rate of this. And in the year three, there is this 5,000, which is subject to a swap at the today's spot rate. So it's going to be 0.143, the rate that's going to be used over here. And this one is going to be at the year three's rate. So the amount that is going to be received in terms of euro is going to be what? And we need to discount them using a discount factor. I'm actually gonna make sure that I convert this into this. I reduce the decimal places. Okay, so that's what I've done. I've made it round off to the 4 decimal places. Now what next is there? We have a discount factor, which is 1 plus r power minus this 14%. So the NPV is going to be 185.64 million euro. Now, this is how you actually deal with this currency swap. Now, a lot of students would actually be concerned about, that how did I actually get this one? And why have I actually splitted this year 3 into 5,000 and into 2,500? So you need to understand, because it says that the swap of principal immediately and in 3 years time at today's spot rate. See here, with the swap of principal immediately and in 3 years time, both these swaps at today's spot rate. So we've actually been able to calculate an NPV of 185 million. Okay, now there is another requirement of the question, and that requirement is that gain due to swap. So the gain due to swap is going to be that if no swap, if no swap, then year 3 receipt of 5,000 of $5,000 would have been converted at year 3 rate. Result would be present value of 5,000 would be as follows. Would be as follows, equal to 5,000 multiplied by this 0.1315 multiplied by 0.675. So that would have been 443, and it is presently 482. So the difference is basically going to be this minus this. So it is going to be 38.8. 38.8 or 39 million is what the gain is due to because of the swap contract. So do you people understand this? Okay. Um. Okay. Was Sumbul Khan? What is it that you did not? Okay. Gain due to swap. Okay. Now what did I do? I said that in case if there is no swap, then year 3 receipt of $5,000 would not be converted at the spot rate, rather that it would be converted at the rate in the 3 years time. So the rate in the 3 years time was actually 0.1315. So what did I do is that I calculated the present value of this 5,000 which is receivable in the third year using the year 3 exchange rate. So when I calculated it using the year 3 exchange rate, the result was that I ended up getting this 444. Now, whereas my calculation under swap have shown 482. So resultingly, if there had been no swap, then the present value of the cash flows or the NPVs receivable in year 3 would have been lower by 38 or 39 million approximately. Sumbul Khan, is it okay? Okay, that's perfect. So basically, we have gone through this requirement of the question also. Now we're left with the last requirement of the question. What is this last requirement of the question? It says calculate the results of hedging the receipt of 7500 million using the currency option and discuss whether currency options would be a better method of hedging this receipt rather than a currency swap. Okay, so we need to see what options are available. We need to see what options are available. We're actually being told that in order to provide Barrier Company board with alternative hedging method to consider, FD has obtained the following information about over-the-counter options in Vertonia dollar from the bank. So there are options in Vertonia dollar from the company's bank. That is the option to buy or option to sell the Vertonia dollar. The exercise price quotation is in Vertonia and the Vertonia dollar per euro, and the premium is percentage of the amount hedged translated at today's spot rate. Percentage of the amount hedged. Okay, so now what do we need to do? We need to actually calculate that in case if the 7,500, which is the residual value, had it been hedged using the options, then what would have been the result? So now let's just try to understand that what would have been the result. Now let's just understand this thing. Okay, see, first of all, we need to understand what do we need to do. Do we need to have call option or do we need to have put options? So basically, we are a company which is based in Euro. We are a company which is based in Europe. So what we are gonna do is that we are gonna receive this Vertonian dollar and we need to convert them into euro. So we are actually gonna sell these Vertonian dollar. So that means we need a put option on these Vertonian dollars. So what is the relevant? It's a put option that's relevant. Now let's just understand. The exercise price is actually mentioned. The exercise price is actually mentioned as Vertonian dollar per euro, whereas the exchange rates given in the question are euro per Vertonian dollar. Now see. So for example, if you actually take exercise price of 7.75, if you take exercise price of 7.75 and the spot rate in 3 months time, which is expected to be, as we have calculated here, which is expected to be this 0.1315, 0.1315. Now this 0.1315 actually means 1 divided by 0.1315. How much does it turn out to be? 7.6. Now this actually means that I can convert these Vertonian dollars 7,500 at 7.6 in the market. So if I convert this 7,500 divided by 7.6, this actually gives me a euro of 986 million. Whereas if I exercise my option, if I exercise my option, I would get a lesser amount because this is being divided. So I would rather prefer that I should not exercise the option. That's number one. Okay, basically I have simply done this 1 divided by 0.1315 because the exchange rate was quoted as a different form, so I converted this form. I mean, whenever you convert direct to indirect or indirect to direct, you just do 1 divided by the quote. So that's what I did. Now similarly, if the exercise price is 7.25, I will exercise my option. Because what am I gonna get? I'm gonna get 7,500 divided by 7.25. This actually gives me 1035 euros. And if I incorporate the premium into it, the premium is 2.7%. Multiply by 7,500. Multiply by 0.14. Multiply by 0.143. Why? Because it is actually going to be in the at the today's spot rate because the premium is always paid upfront. So it's 7,500 into 2.7% into 0.143. So the net receipt is going to be minus 1035. 1008 euros is what we are gonna get. Now you see, let's just try to figure out what is happening. When we had a swap contract, what we got in the year 3 was a cash flow of 1043. You could see the sum here. You could see the sum here, 1043. So when we had a swap, we had 1043. And if we use option, our receipts are actually quite low. It's just 986 and it's just 1008. I have not even incorporated the premium here. If I incorporate the premium here, it would become much lower. So basically the situation is the receipt that we are getting in while using the swap is much higher than the receipt that is actually there when we are using the options. So it's actually the question's requirement was the examiner asked us that we are supposed to calculate result of hedging using currency options. So we did that. I'm going to discuss whether currency option would be a better method of option hedging rather than currency swap. So the answer is no. The options are not going to be a better method of hedging because they're giving a lesser amount, but yet option do have an advantage that they give us flexibility. Now, what sort of flexibility? They have an option. It's not mandatory. The swaps are mandatory. The options aren't mandatory. Okay, so I hope this is okay for all of you. So we're done with this part of the question. Hope there are no questions with respect to this part. Okay, so thank you very much, all of you, for attending the session and for being present there and for the questions that you had. And as usual, as per our daily course, we would highly appreciate if you could share your feedback of today's session, that how was the today's session, and if there's anything that you actually found difficult or you have any comments, we would highly appreciate that because ACCA really wants to know that how do the student feel when they actually attend such sessions. Thank you, Khalil. Steffi Abraham, I would see if I can because there's limited amount of time available and I need to cover up more areas. Thank you, Sajad Ali. Thank you for your comment. Thank you, Iman. Thank you for your comments. Anyone else, if you want to contribute? Omar, we can have a discussion tomorrow. We can have a lengthy session. You can gather all the questions that you have. Joyce, I can understand. I actually paused a bit today. That's why you found my speed to be bearable today. Thank you, Omar Yusuf. Life on Chin, you join the WhatsApp group. I would inshallah help you people have attempt more and more questions. Don't worry about it. Okay, anyone else, if you want to have any comments, any feedbacks, we would highly appreciate. You have a minute more and then we are actually going to end the session then. Amartya, December 2018, important question. The whole syllabus is important and practice every single question. Okay, that's it. Thank you everybody for attending. Thank you for your time. I hope to see you people tomorrow, inshallah. And for the final session of this ACCA exam approach sessions, uh, we'll meet up tomorrow, inshallah. Thank you, and we can then have a conversation in the group. I will become active in the group from tomorrow. No, I'm not been able to communicate a lot on the group, but I'll inshallah be more active from tomorrow. Thank you very much.